Hi, I'm Seth Freudberg. I'm the Director of Options Trading here at SMB in Manhattan, and welcome to our weekly video. I'd like to talk today about pumping up returns on an iron condor. Last week we talked about iron condors, and let me just go ahead and give you a quick refresher course on what an iron condor is. An iron condor is a short call spread that is above the market and a short put spread that is below the market. And to put that in English terms, if the market closes on expiration day anywhere between the short put and the short call, then you get to keep the entire credit that you receive by selling that condor in the first place. So it's a short options spread position, and it's one of the most popular options neutral strategies. So the thing about an iron condor is that there is of all the option strategies, it probably has the highest probability of profit, highest probability of a win, and it also has the lowest income potential. But great iron condor traders do not settle for the income potential of the original iron condor. They do some additional things which allow them to make money on iron condors by techniques to pump up the income potential in the midst of the trade, and that's something we're going to discuss today. So basically, you can squeeze some additional profit from an iron condor, but you've got to do so carefully. Otherwise, like these guys, you're going to get subject to a whipsaw effect. So you want to make money on options trading, but you also don't want to get greedy and then give up very, very nice profits on solid trades because you tried to go too far and squeeze too much profit out of an iron condor. So let's take an example. Today's example is an iron condor in the NDX, the NASDAQ 100 index, and we're going to go back to January of this year because there was a whipsaw that occurred over the 2-month period between the middle of January and the expiration in March, and I want to show you why being careful with your squeezing of additional profits is so important as opposed to simply getting greedy. So let's take a look at this condor that we started in the middle of March of 2014, and you can see that our income potential on the trade is $3,620. We have a short call spread, as you can see, above the market and a short put spread below the market, and that gave us a credit of $3,620. That's what the trade looks like graphically. Now, shortly after we put the trade on, there was a fairly sharp sell-off in the NDX index. And when there's a sharp sell-off, it gives you, as a trader, an opportunity to what we call scalp the quote good side of the trade, the call side of the trade which is shrinking in value, and you want your credit spreads to shrink in value. You don't want them to increase in value. If they shrink and you sold them, that's a good thing. So on February 3rd, there was a big sharp sell-off in the NDX index, and on that day we had an opportunity to close the call side of the trade for a very low amount of money, something like 11 or 12 cents in this case. And so we closed that side because at that point the call side represents only risk, no reward. You're only going to get 11 cents out of it. If that's the most you could squeeze additionally out of that side, so it's better to close it and just end the upside risk on the trade. So that's called scalping the call credit spread side of an iron condor, and that's what we did. Now, how can you get some additional profit out of an iron condor? And the answer is, when you've closed a side, you can reopen that side and try to get some more profit, but you're going to have to come closer to the market to get any kind of a reasonable credit for the call credit spread. So we have to have some rules around reentry because the market doesn't continue going in one direction forever. It reverses, and when it reverses, if you've thrown a credit spread too close to the market and the market reverses, you're going to regret that. So I have 3 rules that I like to use with credit spread reversal situations for an iron condor. Number 1, I like to wait for the market to move hard in the direction of the spread that I'm going to be putting back on. Now that sounds a little counterintuitive. Why would you want the market to move hard against the credit spread? And the answer is because you'll be paid more. Number two, where you place your credit spread can be farther from the market, because we're going to re-enter. Another one of our rules is that we're going to enter under 10 deltas. The short strike would be under 10 deltas. And finally, and probably most importantly, we're only going to resell a half lot. So in this case, we had on a 10 lot, we would resell a 5 lot. That way, if the market whipsawed hard, then we don't have as much risk on the side that we resold. So we can get some extra income. We closed that one call credit spread for 11 cents when we had received over $2 for it originally. So that was a really nice gain. And now we're going to resell it and try to get somewhere between $1.50 and $2 again, but conservatively. So let's take a look. This was a strong rally day, this day of February 7th, which was only 4 days later. There's a strong rally, nice strong rally in the NDX. That's a good day to resell that half lot credit spread under 10 deltas, and that's exactly what we did. So we came in a little bit closer to the market, but we were able to get a very nice credit, and we are able to get some additional income. Now, the profit potential of the trade has gone up to $4,427 because we got paid an additional $600 or so for the credit spread that we bought, and therefore we can earn some additional income on this trade. But look at this graph here. You can see that if the market does whipsaw, it's got to whipsaw quite a long way for us to get into trouble, because we limited the lot size. And so there's less risk up top if we get whipsawed. Well, guess what? We got whipsawed, and this is a nasty whipsaw. We sold off, we rallied, and then we blew past the original entry point. That could give most trades a lot of trouble if we had been greedy and moved all 10 lots down and chased the market instead of waiting carefully for a good and strong rally day and only placing a half lot on. And sure enough, we got badly whipsawed, and even though we did get whipsawed, the trade is still up money well into the rally that came off of that bottom, and we're still up money. And the major reason we're still up money is because we only have a half lot on. We did this on a rally day, and we stayed under 10 deltas, which is a safe delta starting point for an options credit spread. By expiration week, we've earned essentially that full credit. All of this came about. We weren't really meaningfully challenged in the trade because we were not greedy. We did add income. We got a nice bump in income on the strategy, but at the same time, we stayed safe. Once we got up money on the trade, we pretty much stayed up money even as the market went hard against the side that we resold. And that's because we did so in an intelligent and measured way. So what's the moral of the story? You can improve the returns on a campaign of iron condors, on a continuous iron condor strategy that you can do all year. And you can do so carefully as long as you do not get greedy. And following those simple rules that I mentioned earlier is a very good starting point to becoming a better iron condor trader. Don't get greedy. When you resell a side, take half your risk off the table, and do so on a day that's favorable from that standpoint. You should only attempt to squeeze extra profits out of an iron condor by using careful criteria. If you get greedy, you're going to find yourself giving up all the profits that you worked so hard to get in the first place. That's not a good feeling as a trader. So if you have any further questions about this, I'd love to hear from you. You can go ahead and send an email to me at sfreudberg@smbcap.com. I'd be delighted to answer any questions you have about iron condors. So thanks very much, and we'll see you next week. Thank you for watching this clip of our Options Tribe webinar. The rest of the recording is available on optionstribe.com. I'm Seth Freudberg, and I've been hosting the Options Tribe since May of 2011. We've brought in options experts from all over the world to make excellent presentations to our members. So go right now to optionstribe.com to learn more about options education, or you can send me an email at sfreudberg@smbcap.com.